Has the US central bank, the Federal Reserve, finally won the inflation battle? It hasn't raised its benchmark interest rate since last July, after ramping it up to drive down prices that spiraled out of control in 2022. And now that inflation has been largely tamed, Fed Chair Jerome Powell is under pressure to cut that rate. The question is when.
We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
And how this post-pandemic inflation crisis has been solved is a puzzle.
And it's one that even some experts are struggling to explain. Jerome Powell warned that that series of interest rate hikes designed to bring down inflation would be painful for businesses and consumers and might even trigger a recession. Instead, the opposite has happened. The US economy is outperforming every other advanced economy, wages are rising, and employers continue to expand their businesses by hiring more staff, even when the costs of doing so were elevated by those interest rate hikes. And it doesn't stop there. The projection for 2024 is also pretty good for the US.
Even so, with that benchmark rate at around 5.5%, it's driven up the average 30-year mortgage so much, many prospective buyers have been priced out of the market. One argument for cutting rates.
What we're trying to do is identify a place where we're really confident about inflation getting back down to 2% so that we can then begin the process of dialing back the restrictive level.
And yet, with the economy defying expectations, some economists think the Fed needs to consider the lag between hiking interest rates and their impact on the economy before taking action. Owen, Fairclough, CGTN, Washington.